Hey everyone, and welcome to The Explainer. I am absolutely thrilled to guide you through today's topic because honestly, we are looking at one of the most fascinating financial roller coasters of our entire lifetime. We're tracing the wild 17-year history of Bitcoin. Now, for centuries, the history of banking has basically relied on centralized institutions, right? But over the span of less than 2 decades, we've watched this brand new technology transform from a rebellious, anonymous white paper into a heavily regulated trillion-dollar asset class. And the crazy part? It's now secured by the very institutions it once sought to bypass. It is a massive story packed with cryptography, unbelievable wealth, devastating hacks, and a whole lot of legal chaos.
Okay, let's dive into this. Because to truly understand Bitcoin, you have to understand the specific moment in the history of banking that birthed it. On January 3rd, 2009, the pseudonymous creator Satoshi Nakamoto mined the very first Bitcoin block, what's known as the Genesis block. And hidden right inside the code of that block was this exact quote, a headline straight from the London Times. Why? Well, because the 2008 global financial crisis had just exposed some massive fundamental vulnerabilities in traditional fractional reserve banking. Commercial banks were receiving trillions of dollars in bailouts from central governments. Nakamoto embedded this headline as a timestamp, for sure, but also as a permanent, derisive critique of a centuries-old banking system that relied entirely on centralized authorities. That bailout culture, that was the ultimate catalyst for Bitcoin's stateless rebellion.
And when this revolutionary network finally went live on that January day in 2009, its original market value was exactly this: absolute zero. $0. It was purely a theoretical experiment among a niche group of early adopters and cryptographers who were just testing the bounds of digital cash. So let's take a closer look at the catalyst and the underlying code that actually made all of this possible.
Part 1. The Genesis of Bitcoin, the Catalyst and the Code. Just a few months before the network actually launched, on Halloween of 2008 to be exact, Satoshi Nakamoto sent an email to a cryptography mailing list. It contained a link to a brilliantly concise white paper titled Bitcoin, a peer-to-peer electronic cash system. This document proposed something that computer scientists had literally been trying to figure out for decades: how to create a functioning digital currency that didn't require a trusted third party. So the crucial point is how Nakamoto actually solved this, and that is the blockchain. Instead of a bank maintaining a private, closed ledger of who owns what, which is exactly how the banking industry has operated since the Renaissance, the blockchain is a distributed ledger. It uses cryptography to allow a peer-to-peer network to verify and record transactions entirely out in the open. For the entire history of banking up to that point, we had to rely on a central authority like a bank or a government to guarantee our money. The blockchain completely decentralized that trust. Part 2. First booms and busts, the ascent and the outlaws. Moving from theoretical cryptography into the real world brought us into a financial Wild West, completely characterized by staggering volatility. Tracing this timeline, we obviously start at zero in 2009, but by 2013, the buzz is really growing, and Bitcoin's total market cap actually crosses the $1 billion mark, with individual coins hitting roughly $1,000 each. By 2017, we see a massive mainstream surge pulling the price up to over $20,000. And fast forward to 2025, post-regulation, and we are looking at a staggering peak of $126,000 per Bitcoin. The buyers who held on through all of that experienced an unimaginably wild ride. But, we really have to contrast those billion-dollar valuations with the reality of the early days. The very first documented commercial transaction using Bitcoin happened when a developer spent 10,000 BTC just to have 2 pizzas delivered. Think about that for a second. In today's value, those 2 pizzas cost billions of dollars. It's just a funny, completely fascinating reminder of how rapidly and unpredictably the perception of this asset's value shifted over time. And this brilliantly illustrates the underlying mechanical heartbeat of Bitcoin, which is entirely disconnected from human emotion or market panic. The code dictates that the reward given to miners for securing the network is cut in half roughly every 4 years. It's a process called halving. The reward dropped to 25 in 2012, 12.5 in 2016, and down to 6.25 in 2020. This programmed deflationary nature proved incredibly attractive to investors who were seeking an alternative to traditional inflationary fiat currencies. Part 3. The Mt. Gox Catastrophe, the Fall of a Titan. As the value of Bitcoin skyrocketed, it naturally attracted not just enthusiastic investors, but predators. Now, what's really interesting here is the sheer scale of the concentration of risk. In early 2014, a single exchange based in Tokyo called Mt. Gox was handling a terrifying 70% of all global Bitcoin transactions. So a completely decentralized currency had ironically become hyper-centralized around one single, highly vulnerable point of failure. And man, that failure was catastrophic. In February 2014, Mt. Gox abruptly ceased operations out of nowhere. It was eventually revealed that the exchange had been horribly compromised, resulting in the loss of hundreds of thousands of Bitcoin. We're talking hundreds of millions of dollars at the time. The devastation was immense. Everyday investors were completely wiped out. And the fallout was actually so severe that it forced Japan to step in and draft the world's very first formal regulations for virtual currency exchanges. The Wild West had just seen its first major bank robbery, and the sheriffs, they were completely unprepared.
Part 4. The Regulatory Wilderness. Confused Sheriffs in the Wild West.
That global lack of preparation totally set the stage for absolute regulatory chaos in the United States. Without a cohesive legal framework from Congress, federal agencies were basically left to interpret decades-old laws for this brand new technology, and they completely diverged. On one side, you had the SEC treating most crypto tokens as unregistered securities, applying the Howey test from way back in the 1940s. On the other side, the CFTC formally declared Bitcoin a commodity to establish oversight over futures and derivatives. So depending on which agency was looking at it, a single digital asset was two completely different legal entities at the exact same time. This fragmentation left developers and investors completely exposed. FinCEN was actively applying anti-money laundering laws to exchangers back in 2013. Then individual states stepped in, like New York, enforcing the highly restrictive BitLicense in 2015. Fast forward to the early 2020s, and the SEC launched a massive enforcement surge, literally suing major platforms like Coinbase, Ripple, and Kraken. Even a 2022 executive order from President Biden encouraging interagency coordination had no binding power. It was essentially enforcement first, clarity later, a messy, complicated web of parallel state laws and lawsuits with absolutely no real legislative foundation. Something definitely had to change.
Part 5. The 2025 Crypto Framework. From improvisation to infrastructure.
Finally, after 17 years of legal gray zones, the United States caught up. By 2025, the stakes could simply no longer be ignored. In October of that year, just months after new regulatory clarity finally emerged, Bitcoin peaked at an astonishing $126,000. It became abundantly clear that this asset class wasn't going anywhere, and it desperately needed formal legal integration. And that integration finally happened on July 17, 2025, when Congress passed a landmark trio of bills. This established the first cohesive legal baseline for digital assets in the U.S. The Genius Act finally legally defined digital assets and explicitly recognized decentralization as a valid compliance endpoint. Then the Clarity Act created actual, functional regulatory lanes for mature blockchains and compliant token fundraising, essentially ending that multi-year jurisdictional tug-of-war. And lastly, the Anti-CBDC Act blocked retail central bank digital currencies, ensuring the government wouldn't be competing directly with private, market-driven digital alternatives. Let's move to and see how this builds a completely new reality for the asset class. As our sources beautifully summarize, the legislation moves the U.S. from improvisation to infrastructure, from ambiguity to accountability. After 17 years, Bitcoin fully transitioned from a rogue peer-to-peer experiment into a legally recognizable standardized asset. Today, you can literally log into a regulated, nationally chartered bank platform like Sophie, for example, and seamlessly manage your traditional banking right alongside your crypto investments with all the standard consumer safeguards firmly in place. Which leaves us with a truly fascinating paradox to think about. We started this explainer looking at a Genesis block that actively mocked the traditional banking system's bailouts. Yet today, Bitcoin is secured, traded, and legitimized by those exact same financial institutions under strict government oversight. So, I want to leave you with this. Now that Bitcoin has gone from a stateless rebellion to a highly regulated, bank-secured asset, has it lost its original revolutionary purpose? Or, by forcing the traditional financial system to adapt and adopt it, has it finally achieved its ultimate goal? Thank you so much for joining me to explore this incredible journey. Keep learning, keep questioning, and I'll see you in the next explainer.